Hi, I'm Ruth Saldanha with Morningstar. Dividend stocks have long been favorites for Canadian investors, mainly because companies that consistently grow dividends typically maintain competitive advantages and healthy balance sheets. Because of these features, dividend stocks tend to be attractive to investors who are willing to pay up for dependable dividend growth. So oftentimes, these stocks trade at above what they're actually worth. But with bond yields higher than they've been for a while, investors have alternatives to equities, and as a result, we are seeing some dividend stocks that are very cheap right now. Today, let's look at one stock that is trading at a 25% discount to Morningstar's fair value estimate. The stock has a forward dividend yield of 7.14%, and it boasts a narrow economic moat. Today, let's talk about the Canadian Imperial Bank of Commerce, or CIBC. CIBC, ticker CM, is the fifth largest bank in Canada by assets, and is one of six that collectively hold almost 90% of Canada's banking deposits. Now, all the Canadian banks have been down for the last quarter or so, but CIBC has been down the most. Morningstar analyst Eric Compton says CIBC has had a history of not managing risk well in the past. Now, given that history, plus the rising rate environment and increasingly unaffordable mortgage payments in Canada, he thinks that the market is going to be spooked by any bank showing credit weaknesses, and especially will not be thrilled if it's CIBC, which has the highest relative exposure to mortgages among the group. Compton points out that among its peers, CIBC has the highest concentration of uninsured Canadian mortgages relative to capital, meaning that in a downturn in Canada, CIBC would be affected more than other Canadian banks. However, this isn't an existential threat, just a threat to future growth. He also thinks that CIBC may struggle a bit more than peers in 2023, mainly because of a lack of positive catalysts. It's hard to tell what catalysts will emerge for CIBC, specifically that will lead to improved results over the short to medium term. For dividend investors, though, the dividend looks fine to Compton. Though the payout ratio is getting a bit higher in the 65% range, it is not unsustainable. For now, the stock is trading at a 25% discount to Compton's $65 fair value estimate.